Hello friends, welcome to Career Plot. In this lecture, we are going to discuss managerial economics. Now, it might be a new term to you, but in economics world, it is very famous, and generally you will be using managerial economics in your everyday life. You might have not realized it because managerial economics is just to be using economics in your decision-making factors. For example, if you need to decide you want to buy something today, the only thing you will consider before buying is that do you have money in your pocket or not? If you have money in your pocket, can you spend that or not? Is the product useful for you or not? Once you take all these questions, once you ask all these questions to yourself and then try to purchase a product, is called managerial economics, because you have used economics to decide what to buy and when to buy, if to buy or not, right? So managerial economics is theoretical fundamental of economics. Its concepts and analysis applied in solving real world problems to achieve rational managerial decisions. In everyday in organizations, people do those decision makings, and in decision making it helps. So let's take an example. Let's say you want to launch a new phone company, right? So you want to launch a new phone as a product in the market. They already know there are 20 iPhones, there are 20 Android phones. There is one iPhone, and there are other phones in the market, like small feature phones, right? And the price range is also varied. So you would have to still make that call, right? And when you make that call, you will be looking at what will be your strategy, whether you should launch that product in the market or not, what will be the price of the product in the market, what are the different kind of cohorts. Cohorts means the different kind of users, like it's a segment of users, what kind of users you will have for your phone and who will be buying your phone, and what will be your marketing budgets, what will be your other budgets, what will be your production cost. And when you take all these decisions, they will be based on a simple fundamental entities called demand and supply and other things of economics. So demand will decide that whether your phone is having a demand in the market, because the kind of product you are creating, the kind of cell phone you will launch in the market, or will not have a demand. If it doesn't have a demand, maybe it doesn't make sense to launch it. And when you take all these decisions, put in perspective on a table, then that's where you call it as managerial economics, that to take decisions, you have considered all the economic factors of life. When you do this economic factors, you will be actually understanding the microeconomics and the macroeconomics of the system. Now, as per definition, microeconomics is the study of individual firms. It is like, I want to study my own organization. I want to make sure that all the economic factors in my organization, whether my budgets, whether my expenses, whether my income has been accounted for, and that's called internal decision making in the company, which defines microeconomics. Macroeconomics is the fundamental of looking at your surroundings, typically that how external factors impact my economy, how external factors impact my running of my organization. Typically, if you hear the term that how rain or how earthquakes or how natural calamities impact the agricultural produce, or it impacts the GDP of the nation, definitely we are talking about macroeconomics, that the factors which are beyond the control but impact your income or impact your revenues is definitely macroeconomics. So the difference between micro and macro is very straightforward, that micro will look at the things which are in our control. Macro is look at the things which are beyond our control, typically. Now, using macro and microeconomics, when you have discussed and made some product strategies, definitely you consider another thing called the cost. Now, cost is not only the production cost. Let's say if a cell phone is 5,000 rupees, it does not mean that it has costed only 3,000 rupees of manufacturing and 2,000 rupees is margin. people calculate three types of costs. One is opportunity cost. Opportunity cost is all about if I don't launch in the market, what will be the costing to me? If I launch in the market, how much value it creates in the market, how much money it has a potential, right? So opportunity cost is theoretical cost, but definitely adds up when you want to make your product strategies, right? Economic cost is having two parts of implicit cost and explicit cost. Implicit cost is about development cost. Generally in the software world, if you look at, if a software is priced at $100, doesn't mean that the its implicit cost was just $80, because the developers who were working on it might be very, very expensive. It might be a team of 100 developers taking a salary of $100,000 per annum. And then if you factor in the number of copies of software has to be sold high. The explicit cost is the price which we would put to the product, which is like $100 of the software. The third is the social cost. Social cost is whether this product makes an impact in the society, what kind of impact it creates. Let's say if a software is helping you reduce the paper usage, that means it is helping in going green and reducing the cutting of trees. That means it is making an impact of worth, let's say millions of dollars in saving forests, right? And increasing the and decreasing the carbon footprint on Earth, right? So this is a social cost. And when people launch their product, they do actually factor in all the cost and put their right marketing strategies and product pricing and the whole product development cost in perspectives. Now, once we discuss the cost, there's another thing called economy of scale. Now, economy of scale is very, very different than the costing factors, but it helps in decision making. Economy of scale is very simple, that I want to produce a mass, I want to go into mass production. For example, I want to produce millions of phones. I want to produce millions of copies of software versus I want to produce only 100 copies of this software. It's like limited production versus the mass production. So in the world of cars, for example, Lamborghini or a Ferrari is called limited production. They might be producing only 100 or 200 cars or 500 cars a year, or let's say 1,000 cars a year. But in case of Honda Cities or Hyundai or any other cars, general purpose cars, they are being produced in millions of cars every year, right? And that's called economy of scale that they are looking, and that's why economy of scale drives the price too low, because a million product copies into even $10,000 or $1,000 will make you a lot more money than 100 copies multiplied by a million, right? Because the sales cost of a high-end product is very, very high, and the sales cycle is very high, which we are going to cover in later lectures about the sales cycles. But selling cheaper products on the economy of scale is much higher. For example, if I make this course available at, let's say, 1 lakh rupees, then there will be a lot less people buying it. But if I am making it cheaper available, there will be a lot more people buying it. And my social cost is to increase the education sector, to make an impact in education sector, to make more people aware of marketing, to make more people aware of job opportunities. And this is how I can do it, by keeping the cost low, educating people about it, and then talking about it on the economy of scale. An economy of scale definitely creates a lot of high entry barriers. Now, high entry barriers are defined as the barrier where a company, another company, you mean your competitors or a potential competitor, what it will take to enter the market. For example, if someone wants to enter a car market, creating, and they have a lot of money in their pocket, creating another Maruti car will be much easier for them on the economy of scale, on the economy of limited system, right? But if they look at the economy of scale, they have not only to manufacture the cars, but they have to set up distributorship. They have to set up service networks across India or across the world. This is what Maruti has done on the economy of scale. Compared to Lamborghini, if someone has to manufacture Lamborghini, what they need to look at is the technology only. That once they know the technology, limited development is very easy because it will be very controlled and very limited to an environment or limited to a geography in that sector. So economy of scale does create high entry barriers, and that's why launching an e-commerce company is much tougher in this market today because of already being more than 20 players, large players in the market. So becoming a 21st player is not easy. So just to quickly recap, in this session we learned about basics of managerial economics, which will enable us how to take decisions and on what factors we should do it. The basic two entities always have to be kept in mind, the demand and supply. And you should take care of that there has to be a demand. There has to be significant demand in the market for your product. If the demand is not there or demand is not good enough, you should consider or reconsider a decisions again and again until the demand hits or until the right time happens for you. Then we looked at microeconomics and macroeconomic factors. A lot of people do look at microeconomics in these companies by doing a simple calculation of budgeting that, okay, this is my money in my bank account and I can spend this, but they don't look at the macroeconomics, which is like how other factors can impact my product. For example, if my competitor goes on a very low price and I'm not able to sell at the same price, that my product might not work in the market at all. Then we looked at the concept of cost, as I discussed, that this is how it works in the people mode. So concept of cost is important to understand. And then we talked about economies of scale and how to make sure limited scale versus the large scale problems are solved. Thank you.